Welcome back. Well, in the next few minutes, we'll get the pre-opened rates. But today is an important day of trade because, post today, we'll react tomorrow to what the Fed has to say. In that sort of a backdrop, well, Anuj joins us in the studio. Hi, Anuj. We've had a good run. Clearly, the Fed and the market watchers want to see a dovish Fed. How do you approach trade from here?
Yeah, obviously, the Fed is the key talking point, Nigel, but our market have their own momentum. And, the way retail has really trumped FIs and from 16,800 to 18,000, and now even FIs are long. In fact, for the first time since August, the FI long position is more than the retail long positions. So maybe that actually may not be the best thing for the market, because normally markets do well when FIs are short. The other point which I made yesterday as well, I think even Prashant had highlighted it earlier, the ETF inflows that we have started to see. Now, after Brazil's election and Brazil electing a clear far-left government, obviously it will see, less inflows. Anecdotally, it was clear from 2002 to 10 period when you had the last left government in Brazil. So India clearly stands out as something in sweet spot in terms of FI flows, and that is something that you've started to see, because in BRICS countries, that's the only country which now offers you good returns. Now, in terms of traders' point of view, I think the Nifty just for the near term is stronger than the Bank Nifty because of the way Nifty IT has bounced back. And today it has some more good reasons for that because of Tech Mahindra's numbers. Also, Reliance is supporting. In fact, the Nifty IT is now just 6% away from the 200-day moving average, which is the mean reversion trade which is played out. It's rallied 12% from the lows. So that is something which could keep Nifty at least in good stead. And it's shown signs of moving to new all-time highs. 18,200 is a bit of a profit-taking zone. So maybe some profit taking there, but post-Fed a new high. I think on the Bank Nifty, the sentiment got a bit hurt by what happened with Axis Bank yesterday. But overall, I think the strength is intact. The all-time high is very close. I think the bigger move may happen post FOMC and MPC, something that I highlighted yesterday as well. Positionally, though, it's the strongest of the indices. And just one point I want to make, this ETF buying, just keep an eye on HDFC Bank. After a long time, you've started to see massive buying in HDFC Bank. In the last 1 month, HDFC Bank has gone up 7%, which is something we have not seen for a really, really long time. If FI money starts to chase HDFC Bank, that will help Bank Nifty actually cross all-time highs, because other components are very strong. ICICI, SBI, and I dare say even Axis Bank, despite yesterday's weakness, is a strong stock. Yeah, that's the chart. 1 month, 7% move in HDFC Bank. This is that FI money which is chasing some of these stocks.
Okay, Anuj, thanks a lot for that. By the way, that's the opening on the rupee. Not too much of a move compared to what we saw yesterday. Still at that 82.64 mark. It assumes importance ahead of the RBI's unscheduled meeting that takes place tomorrow. So just keep tracking that one as well. In pre-opening, the Nifty is down about 23 odd points, not moving too much. Couple of stocks do deserve mention though. Eicher Motors, very strong numbers this time around, and despite a 47% rally this year, Eicher Motors continues to trend higher, up almost about half odd percent. Adani Ports is up almost about 2 odd percent. We spoke about that stock a while back, and a couple of other names like Sun Pharma continue to move ahead. Chandan Taparia, who's the derivative and technical analyst at Motilal Oswal, is with us. Chandan, good morning. Your thoughts on the index and what are the individual stocks that you're looking to buy today?
Good morning, Sonia. We have seen good run-up in the market, and base of the market is gradually shifting higher. The good part is that FI's long-short ratio has increased to 60-65%. Put-call ratio is stable above 1.3, and volatility is falling down gradually near to 16.5. So rising PCR with falling put-call with falling volatility indicate the bullish bias in the market. And we believe that the structure is so strong that any decline could be bought in the market towards 18,350 to 18,500. So in index, we will continue to be with bullish bid with support of 18,000 for an upside target. However, we have Fed and RBI meeting, but we believe that any kind of volatility or decline could be utilized as a buying opportunity in the market given the price internal and the structure. Now, looking at the Bank Nifty index, that is just few points away from the lifetime high, but consolidating a range with some profit booking decline at higher level. But here also we believe that with support of 41,000, it can head towards the lifetime high of 41,840 level. Now, looking at the stock wise, we are positive on the Sun Pharma. This is one of the strongest pharma counter. This is the stock which is continuously making high rise, high lows from last 7 consecutive weeks. We have seen 85% rollover with built up of long position. So recommending to buy Sun Pharma with a stop loss of 1,020. And here we have a target towards 1,080 level. Apart from that, we are positive on the selective cement name. So here we like Ambuja Cement, which has seen 98% rollover from last series to current series, clearly indicates that longs are holding. And it has given a consolidation breakout of last 25 trading session. So a small follow-up could deliver the movement of 5 to 7%. So cement stocks are in action, and we like Ambuja Cement for an upside move towards 570. So one can buy with a stop loss of 534. Last trading idea that is from Capital Goods, buy on ABB, 89% rollover, 6 to 8% long added in last 2-3 sessions, bottomed out with support of around 3120, 3140 levels. So recommending to buy with a stop loss of 3120 and expecting ABB to head towards 3300 levels.
Okay, all right, Chandan. You have a good session ahead and always good hearing your thoughts. Thanks so much for stopping by. Well, let's get to our first management on the show, Max Healthcare. That's the first corporate we're talking to today. The hospital revenue looks strong, occupancies as well, at around 78%, and the average revenue per occupied bed as well moved up pretty strongly. To discuss the performance, the outlook from here on, we're joined by Dr. Abhay Soy, the chairman and MD of the company. Hi, Abhay. Morning. Thanks so much for joining in. Congratulations on a rather good set of numbers. My question to you is, occupancies have moved up to around 78% odd. Do you expect that to be the number that we should be working with regard to occupancies? You could give us a broad band. And the other factors, your revenue mix. You know, it's turned around, as you have been indicating. Institutional contribution has come down, while international contribution has moved up. With that sort of a backdrop, what kind of an average revenue per occupied bed we should be looking at?
So what we are coming off, and typically the second quarter is, the viral season, the dengue season. So what you tend to get is a lot more medical patients. And this season is characterized by two things. One is higher occupancy, which you saw. And the second is because it's only medical management, it's not really surgical management. You have a little stress on the RPOBs. So therefore, what you saw is RPOBs were sequentially flat last quarter to this quarter, whilst you got the benefit of the higher viral load, etc., and occupancies were higher. Both of these combined, because higher occupancy does give you some operating leverage, and therefore we've had another quarter of all-time highest revenue and EBITDA.
Right, Abhay, so just what is the guidance on, as you said, yourself said, RPOB quarter on quarter is flat. Where does this move from here in the second half of this year?
So, typically a second half of the year is usually better than the first half of the year, marginally better than the first half of the year. So what you're going to see is, of course, as far as occupancies are concerned, it's you're not going to have a 78% kind of occupancy when you come off the season in the first quarter, in quarter three, but you will have higher RPOBs compensating for it because you've got, a better surgical mix, more surgical patients, which typically tend to pay you a higher RPOB. I think this coupled with the fact that we are also seeing extremely high clip of recovery as far as our international business is concerned. We are already back to more than 110% of pre-COVID levels. And this is whilst, Afghanistan, which is one of our key markets, which used to be 12% of our total business, is really down to a trickle right now, is down to zero, because the Indian embassy is not really issuing many visas over there or any visas over there. So once that comes back, we're going to see a massive flow in through that geography as well. So yes, I think, occupancies will move up marginally from a base rate, but you will definitely see a significant move up as far as RPOBs are concerned.
Okay, just some more numbers. RPOB, just for the uninformed, is the average revenue per occupied bed. And over there, as we were telling, our viewers earlier, you've done very well, 66,000 rupees this time. But now that you're seeing perhaps medical tourism also return in a big way, as you said, international patients could come back in a big way over the next many months. From this level, what kind of sustainable growth do you see by the end of the fiscal on the RPOB?
Well, we're not giving any guidance in terms of top line and bottom line. But having said that, what I can say is this is not a one-time sort of performance, etc. We have some levers coming through in the near term. Higher throughput of international business is one. Lower sort of dependence and reduction in institutional business is the second. And both of these should play out in higher RPOP, and coupled with the fact that now you're getting into the winter months, which are more surgical and more surgeries, etc. And that's what we've seen typically in the past as well, that the second half of the year is usually marginally better than the first half.
All right. Could you give us a number, Abhay, on that institutional contribution? It's moved down from the mid-30s. It's come down to sub 30% odd. In revenue, obviously, it'll be less. But what's the targeted number out there?
I think over the next 4 to 5 quarters, we should have it below 15%.
Oh,
okay.
From this 28% odd mark.
That's right. That's right. So you've seen over the last 3 quarters, it's been brought down from 37% to 28%, but now from 28 to 15 will be over the next 4 quarters.
Abhay, just briefly, you in the first half of this year, you've spent some 40 crores towards sort of capex related initiatives. What is the plan for the second half? Will that number be significantly higher?
Yes, we are looking at 400 to 500 crores to be spent in the second half of the year. We are looking at the first 100 beds to be commissioned by very early on, in late current financial year, and then another 300 beds to be commissioned. This is in Dwarka in very early on in the next financial year. So you're going to see about 400 beds come on stream, I think in the near future, and which are pretty much in line. And other than that, we are incurring capital expenditure towards some of other projects as well, where the visibility is good and expenditure should go through as well.
Okay, all the best, Abhay. Thanks a lot for joining in. That's Max Health. The occupancies are very high. This was one of the worst flu seasons we've seen in a really long time. So occupancies have definitely gone up, and the average revenue per occupied bed has also been very strong for Max Health. But let's get some comments on the market now. Sudarshan, what's the big call at 9:10 this morning?
Well, buy the Nifty on a very sharp dip of about 100 points. Lupin is a buy with a stop under 685.
How about you, Mitesh?
Yeah. I will go with a buy on Mindtree with a stop at 34.65 for targets of 3600.
All right, thanks a lot for that. Well, the top Nifty gainer this morning is Eicher Motors, and here's the reason why. It has had another month of blockbuster sales on Royal Enfield. The total Royal Enfield sales have gone up 86% on a year-on-year basis, and the models with engine capacity of up to 350cc has gone up 100% year-on-year. So very good sales, and the bar graph will also be up on your screen. But the big question we're asking, a large part of the sales this month came in from the new Hunter, and the Hunter is about 50,000 rupees cheaper than the classic 350cc, which means that Eicher Motors is perhaps sacrificing margins for the sake of higher volumes, and that's the big question. Will their margins get diluted? It may be offset by lower raw material costs and some cost efficiencies that the company has been speaking about, but by and large, the margins perhaps could get diluted because of the higher Hunter sales. But give and take everything, this of course is the big stock to watch today because of very strong Royal Enfield sales in the month of October. But let's find out more on Sun Pharma. Ekta is here with that. Ekta.
Thanks for that. Well, the conference call was held post-markets yesterday, so it is going to really be reacting to the management commentary this morning. So a couple of important takeaways. The global specialty sales were up 27% year-on-year to $201 million. It was really led by Ilumya, which is basically their psoriasis drug, followed by Sequoia, which is an eye drug, Winlevi, which is an acne drug. The Sun is exploring in-licensing as well as M&A opportunities when it comes to its specialty pipeline. Price erosion in the US generics remains unabated. That is something that the street is focusing on. The Halol plant official action indicated status. Sun continues to implement remediation there. The growth runway, the company has said, is reasonably long for key products in their portfolio. They haven't really changed any kind of guidance as well. Brokerages positive across the board except for maybe one or two. So Bernstein, Morgan Stanley, Nomura, Citi, most of them have raised their target prices, including the likes of Credit Suisse. They have basically said that the company is well diversified. Business is helping Sun to manage their business volatility, US to continue overall growth going forward, and there was a strong margin performance as well, which will aid going forward. Goldman Sachs is probably one of the only outliers. They have a sell with a target price of 830. According to them, There is an intensifying industry-wide US price erosion, which will impact Sun and Taro. Slower than more normal growth for the global specialty business is something that they would watch out for going forward.
All right, Ekta, thanks very much for that. Volta's reported numbers as well. Vahishta is revisiting that. Vahishta, hi.
Hi, Prashant. Good morning. Well, Voltas, the numbers have not been very appealing. In fact, the revenues have grown 5% on a year-on-year basis, but the weak point has been on the margins front, which have come in at 5.8% versus 7.7% in the same quarter of last year. The estimates were at 6.6%. So the weak margin performance continues even in this quarter. The bottom line, though, was impacted by an exceptional item of 106 crores. Now, in terms of segmental revenues, the unitary cooling products division revenue saw marginal growth of 4% in this quarter, but was below the estimates. The segment was also impacted by the lower consumer sentiment, which was towards discretionary spends in a generally lean quarter. The room AC market share has also lowered to 22.8% for the 8 months of the ongoing calendar year. Now, in terms of brokerages, Axis Capital has a target price of 1,050 rupees, while Macquarie has a neutral rating on the stock.
Okay, thanks a lot for that. Well, here's the opening for the market. It's not as bad, actually. The first tick on the index is absolutely flat, just buying time ahead of the FOMC meeting. The Nifty holding at that 18,150 mark. We're just within kissing distance of that 52-week high. So do keep that level on your radar. The 52-week high is 18,350. Now 18,140 on the index. Absolutely flat for both the mid-cap as well as the bank Nifty. The good part is the advance decline ratio is well in favor of the advances. So the momentum is definitely on the upside. In terms of individual stocks, your big Nifty gainer is Eicher Motors, 1% higher on that one, followed by Hindalco, ONGC. Tata Motors as well is up almost about 0.6%. Very strong passenger vehicle sales this time, especially the electric vehicles, so looking pretty good over there. Tech Mahindra, the street perhaps likes the fact that the margins have improved, up 0.3% for Tech Mahindra. L&T continues to charge ahead post its good set of numbers that it reported. UPL is up almost about 0.6%. Couple of other names, Dr. Reddy's in the green, ICICI Bank, Kotak Mahindra Bank are holding fort. Interested to see what SBI and Titan are doing. Titan comes out with numbers on Friday, SBI on Saturday. And ahead of these earnings, the stocks, Titan is down about 1% and SBI I think is flat, just about trending a tad bit in the red. Talking about red stocks, you have Hero MotoCorp, which had a very disappointing set of numbers. So down 1.5%. Bharti Airtel perhaps coming in for profit taking because it's had a very strong run lately. Maruti Suzuki also disappointed a tad bit in its numbers this time. The sales were down 5% month on month. And largely FMCG, whether it's Asian Paints, Nestle, Titan, all trending a tad bit in the red. But otherwise, very, very quiet opening, just buying time ahead of the big event.
All right, Sonia. Well, from the broader market, you're getting quite a few earnings reactions, actually. Karnataka Bank, out there, the NIMs came at multi-year highs. The asset quality is well improved. And the street likes those set of numbers. I think we should get Abhishek shortly to talk about these numbers. It's up closer around 15% as we speak. LIC Housing Finance, on the flip side, that's down closer around 10% odd. So that's taken a hard knock in reaction to its numbers. Margins were weak, asset quality as well did deteriorate a little bit. So that one as well was lower. Chola Finance, in fact, that started off in the red, but that dip has quickly got bought into. It's up closer around 3% odd. It was down 1% in the first tick. Kansai Nerolac, let's see how that one's reacting in today's trading session. The numbers, well, they were not very impressive at all. Stock is down closer around 2% as we speak. A couple of other big movers today. Chambal Fertilizers, that's down closer around 4.5%. Page Industries as well down closer around 1.5%. And the Nifty, from making a high of around 18,170 odd, now we're down closer around 25 points odd. Some profit taking is what we're witnessing on the headline index. Prashant.
Okay, so 20 points basically is you highlighted. Karnataka Bank is a big mover. It's up 19%. It's the top traded stock as well. So this is coming up with a huge thrust, volume-led thrust. The Adani Group stocks all did very well. Ports and enterprises on the Nifty and others outside of the Nifty as well. So Adani Wilmar is starting 1.5% higher on very strong volumes. The metal names continuing from yesterday. Tata Steel, Hindalco this time. Chola Finance, we speak with the management a little later. It's up 3%. Varun Beverages had a very strong day yesterday. There is follow-through to that. Actually, it's a pretty strong volume day for this time of the time of the day, which is just about starting. 3.5 higher on Varun Beverages. Max Health, we just spoke with the company. That's up almost 2%. Jindal Steel is about 1.7% in the green. as well. So this is, the broad list of what is moving higher. And of course, LIC Housing Finance is the one which is taking a sharp knock. It's down a full 10%. So it's a limit down basically, 360 on pretty large volumes as well. Bharti is coming off. Bharti, I guess, pre-positioning. The stock did not react very positively yesterday. It's down another 1.5%. Bandhan Bank has been having all sorts of troubles. Another 1.5% gone. Vahishta highlighted Voltas just 10 minutes back. That is down about 1.5% as well. So this is basically the start with lots of stocks moving around. The index not so much, just 20 points lower, 18,130 odd. So this is a flat start. Mihir Vora is our market master today. He's Director and Chief Investment Officer at Max Life Insurance. Mihir, it's a pleasure. Great to have you with us here on the program, on the channel. Thanks very much. So the question, Mihir, simply is, will this time the market make a new high? I mean, third time lucky in that sense. Maybe lucky is the wrong word. But in September, we got to these levels and then the market fell. Back in April, we did something similar. Even actually earlier in January of this year, we got a throw-over kind of price action. The market went up above these levels, but eventually came off sharply. Are conditions ripe now? I mean, is the mix ripe for the market to do meaningfully better this time? Your sense?
Good morning, Prashant. Yes, definitely the earnings momentum is there, the results are there, and there is a bit of a fundamental tailwind, so to say, as far as the markets are concerned for the domestic economy. With a little bit of support from the global markets and the global situation, we could probably cross the new highs. But as I said, we need support from the global markets. There are a lot of uncertainties out there. Markets have run up quite a bit in the last couple of months. So we do need the tailwind from the global markets. With that, we can definitely make new highs.
Okay, we need the tailwind from global markets. By the way, just a couple of stocks, right? Varun Beverages reported a very strong set of numbers yesterday. That stock is seeing some follow-on buying this morning. It's up an additional 5%. Piramal Pharma, we were referring to that earlier with our guest. That one's looking pretty good. Chola Investments post its numbers is up almost about 3% and Max Health, we had some positive commentary from the management. So Max Health is up almost about 2.5%. Mihir, good morning. So until we get that tailwind from global markets, our own markets have not done too bad. So what are the pockets that you like now? I mean, where do you see the next leg of leadership emerge from?
I think we continue with the domestic theme. We have been bullish on the domestic economy for quite some time. More urban than rural. I think consumption is stronger on the urban pockets. Rural pockets are still to catch up. So a bit of a K-shaped recovery, but we have seen that the markets do represent a fair chunk of the, the large corporates and the organized sector. So to that extent, maybe the rural weakness is still not reflected in the market, except in some pockets of FMCG, etc. So stick with the, the domestic theme that includes financials, industrials, cap goods, EPC, and of course the discretionary segments like not only the services like hotels, etc., but even automobiles and thereabouts. Real estate is one segment where we are seeing some traction, and if hopefully we are nearer to the end of the tightening cycle by the Federal Reserve and the RBI, and if interest rates don't move up much sharply from these levels, then even real estate seems to have a good underlying base demand that should drive the domestic economy.
Okay. Hi, Mayor. Morning. You seem to be liking these domestic themes, and you've been echoing that as well for the last couple of interactions that we have had. But Mayor, I wanted to ask you, the IT space or the IT index, the stocks out there, they had a brilliant 1.5 to 2 years odd. Is banking at that kind of a cusp where the next couple of years will be good for banking stocks, or any other sector that you believe could do what IT did, even do 50-60% of what IT did in the last couple of years?
Yes. So banking, while the banking index is near its all-time highs, in terms of valuations, we are still below pre-pandemic levels. If you look at the price-to-book ratio for the banking sector as a whole, because earnings have caught up. So I think next few quarters, at least 2 quarters, I can see that we are in a kind of a Goldilocks situation where the assets are getting priced much faster. The liabilities, deposit rates are going up, but not to that extent. So we have a period where we are seeing improvement in margins for the banks, and we are seeing that NPAs, for which very aggressive provisions have been done, are not going to creep up at least for the next couple of quarters. So it's a ideal situation where you have credit growth happening, no NPA major issues, margin expansion, and the fact that valuations are still below pre-pandemic levels. So that's one pocket I can clearly see where there is value. Even automobiles, for example, if you look at it on a case-to-case basis, valuations and even demand for that matter is just about now coming back to pre-pandemic levels, a little above pre-pandemic levels. So a lot of catch-up to do as far as the domestic discretionary consumption is concerned. And of course, if we are talking about government continuing to roll out PLI schemes, Atmanirbharta, defense manufacturing, localization, then I think this whole capex and EPC theme should also continue to do well.
Mir, the local consumption theme, right? You'd put out an interesting graphic on your Twitter handle a few days ago saying how government support has been key in maintaining the consumption levels, right? Especially rural areas, and there was a bar graph. The point is, a lot of it is the support has gone up substantially because of price inflation. Fertilizer subsidy, for example, will be at an all-time high. It perhaps will get revised for what the government needs to pay out from what was budgeted. So this is, in a way, a pass-through, inflation-led, right? How much of this is sustainable in your opinion? Fertilizer is a huge component, so I'm picking that out specifically. Go on.
No, absolutely. So, the kind of support that the government has given to the rural economy is almost, and just at the central government level, I'm not even talking about state government support. Central government support has been almost 3 to 4% of the economy for the last couple of years and likely to be there for the next year too. So, I mean, on one side, while we can say that, yes, consumption has done well and held up, especially in the rural area, has held up because of government support. On the flip side, one could imagine if that support was not there, then what the situation would be. So the fact that the markets and the corporate earnings have held up in the consumer segment and many other segments quite well is because of this huge government support. We should not forget that. So yes, and at the beginning of the episode, I did mention in passing that overall, while consumption is doing okay, it's more the rural which is driving it. The urban, more the urban which is driving it. Rural consumption is still kind of coming up, but with a much lesser impact, so to say. So I think the rural economy is still facing the inflation headwinds, and we will continue to need government support on the rural side. Good thing is that tax collections are healthy. You can see the GST numbers. So there is ammunition for the government to keep this going. And I think they will, because inflation is something that hits the poor the most, and the government will continue to support the rural economy. So we should at least see maintenance of consumption in the rural side, if not acceleration.
Okay, but even in rural, right, Mihir, there are some signs of a recovery. I mean, if you look at pockets like tractors, for example, M&M, Escorts reported good set of numbers. These are wholesale numbers, so we don't have the retail trends just yet. Retail trends have still been on the weaker side. But don't you think that this is the time to jump in where there are nascent signs of a recovery in rural?
No, absolutely. Tractors have been doing well for quite some time, and we have been bullish on that. But again, tractors, etc., are not necessarily linked only to agriculture. There's a lot of construction-linked demand also for tractors. So whenever there is Manrega activity happening, whenever there is road building happening, or construction of ponds, etc., and even transportation. Tractors are used for rural transportation in general too. So that's one aspect, and also the richer farmers, the bigger landholders are anyway doing well because of price inflation on the commodity side. So I think even within rural economy, we have to differentiate between the rich, large landowners and the subsistence farmers, which don't really benefit even from food price inflation. So if you look at the larger ticket items like tractors, they are doing well. But if you look at the two-wheelers, etc., they're not doing that well. So there also probably there is a bit of a K-shape.
Mihir, some of these China plus one themes, they did very well, like the specialty chemical space as well. Do you think they have more legs from here on? Some of them have come off the top, but there's still a big opportunity. And suddenly from China plus one, there's a Europe plus one as well that's playing out. You believe it still has more legs out here? Because valuation-wise, well, they've gone up quite a bit.
No, absolutely. So keeping aside valuations, this structural theme is here to stay. The easy energy, the cheap energy days for Europe are probably gone forever. They have substituted with renewables or something. And we are already seeing some major companies shifting production or planning to shift production out of Europe. Now, whether it comes to India or not, that's the second question. But there is definitely a Europe plus one opportunity happening. So in these chemical companies, I would look at the margins for the last 5 years, not 5 to 6 years, not necessarily the margins for the last couple of years, because last couple of years, there has been a huge distortion for supply chains, raw materials. So it's very difficult to figure out what the core margins are. But if I were to look at the longer term margins and then build a volume case around it, that's the way I would look at it. So if you look at most of the companies, since they've done so well in the last 2 to 3 years, a lot of capacity expansion is happening. So maybe there'll be a point in time where capacities will come up, probably not get utilized, maybe a bit of a margin squeeze because of lack of capacity utilization. But over the long term, I think that should ease out, and we are seeing huge volume growth coming up. So I would really play for volume expansion rather than margin expansion for these companies.
Okay, all right. Well, we'll leave it at that. Thanks a lot for joining in, Mihir. Have a great day and a week ahead. Thanks for that. Well, for the market, it's absolutely quiet, but there are definitely some stocks that deserve mention. Cement is coming back. So India Cements is up almost about 3.5%. It's had a good run this year. India Cements up about 31%. You have real estate. We'll talk about that in greater detail in a bit. Brigade Enterprises is doing pretty well this morning, up 2.5%. And then something like Devyani International is up about 3%. But good set of numbers from Nykaa. Of course, it's a different issue that the stock has been very bumpy because of the lock-in period ending. But the results were not bad. Revenue was up 7% sequentially in a seasonally weak quarter. In fact, we spoke with the management on the outlook. Listen in to what they had to say.
We're quite pleased with the fashion performance for Q2. Fashion has grown 43% year on year. It does contribute about 26% of the consolidated company's turnover. I think we're furthermore feeling good about the business in the sense that it is continuing to be contribution margin positive with a clear line in sight in terms of profitability. And then lots of other core metrics are looking good, whether it's a much higher average order value, whether it's the expansion of share of our private labels. So overall, feeling that a lot of metrics are headed in the right direction from the fashion business.
Beauty, which is already a mature business, but we are benefiting from margin expansion in beauty because of our size and scale, where we are now in beauty business, taking our warehouses closer to the customers. Earlier, we used to have maybe in 5 regions, we had most of our warehouses, but now we are going in many states, including almost 15 states where we may have our warehouses over medium term. So that is putting us closer to the customer and helping us control our fulfillment costs. We are in a very good place on a beauty business as well as on gross margin expansion due to our service income coming in line with, we are able to drive better service income because of becoming a platform of choice for brands to market on our site.
I think we find a marginal difference in terms of the cost of customer acquisition, but they're pretty neck to neck. What we do find is that there's a difference in obviously the repeat to new behavior on the beauty versus fashion side, with beauty obviously being 5-6 years ahead in terms of the journey. And so therefore the marketing costs on the beauty side, do have the benefit of just having a very strong repeat behavior playing out. But I think what we're feeling pretty good about on the fashion side as well is that now as we're entering, the end of the 3rd year and entering the 4th year of the fashion journey, we're finding that similar sort of repeat behavior is finally starting to kick in. And so, this quarter is the first time we've sort of released the fact that 66% of fashion's revenue is coming from, fashion's GMV is coming from repeat buyers. So we do feel that, again, that similar cost structure that we were able to achieve from the marketing point of view and the beauty side should be within fashion's reach in the near future.
Okay, that's the word coming in from Nykaa. Good set of numbers, but let's move from makeup to homes. Macrotech Developers posted Q2 earnings yesterday. We got the operational update a few weeks ago and it was very good. The company clocked in its best ever quarterly sales, which takes sales for the first half to around 6,000 crores. Remember, the company's full year guidance is at 11,500 crores. Sushil Kumar Modi, the CFO of Macrotech Developers, joins us now to talk about that. Mr. Modi, good morning and thanks for joining in. Since you've done a little more than half of your full year guidance in the first half itself, would you want to scale up your guidance for FY23? 11,500 crores is your target. Do you think you can beat that?
Hi, morning, Sonia. No, your point is pretty valid, that looking at the strong, robust demand and the kind of performance that we have achieved in the first half, certainly, we are on the journey perhaps to outperform our own guidance. But nonetheless, we are equally cognizant of some of the macro developments that are happening all around us in terms of interest rate and whatnot. And henceforth, to that extent, we would equally like to be cautious before kind of, rather instead kind of outperform our own guidance rather than kind of keep revising the guidance at this point.
So even if you don't revise the guidance at the moment, do you think that by the end of the year you could do much better than this level of 11,500? Jefferies has put out a note where they say that a 13,000 crore sales target by end of FY23 is reachable. Would you agree?
We definitely agree, and in our mind, potentially, as I said, we would outperform the number, but I wouldn't get into the specifics of how much of the outperformance we should finally get to. But nonetheless, you can just simply, take the clue from the fact that generally the second half of the financial year, due to festivities in and around the country, delivers kind of 60% of the business. So if the 6,000 crore has got delivered in the first half, it is no-brainer perhaps for all of us to recognize the kind of potential and thereby the outperformance that we all would end up in achieving.
So you're not revising it officially, Sushil, but you also agree with Jeffrey's target, right? As of now, that sounds realistic.
Yes, I would say realistically one can definitely.
Right. Okay, we let for the time being, we'll stick to the guidance that you have given, and maybe by the time we meet for the next quarter, maybe you'll revise it going by the traction that we're seeing on ground. But pricing is important as well. So tell us, what is the average realizations that you all have? Point number one. And also price hikes have come about, right, in the last 1 year or so. Do you believe there is scope for further price hikes from here on?
See, I think we are into an industry where the price hike is absolutely essential. But equally, the fact is, the price hike at no point of time should end up in kind of impacting the affordability, because which is where the industry starts suffering. And that is why the strategy that we have adopted, and kind of, quite a number of times we have elaborated as well, that we would like to ensure that the price rise at no point is kind of, exceeds the wage growth in the country. So if whatever is the wage growth, potentially the price rise should only be 100 pips lower than the same. And so long that is there, that means the affordabilities continue to kind of improve quarter on quarter and year on year, and which thereby enables the housing demand to unfold, because we clearly see there.
Sushil, I'm looking for a number. Sushil, what is the average realizations that you all are currently sitting on? And then we can take it forward.
So effectively, we have achieved, our realization effectively is kind of 11,000 to 12,000 rupees a square feet on an average, because as you would appreciate, the number as such really won't matter, because we cater to the affordable segment, to the luxury segment, and the price kind of, varies significantly, So henceforth, on an average, if you look for, then potentially the number is somewhere around 12,000 rupees per square feet. But what is important to your point is that, yes, in the current half itself, we have seen across our project, 2% price hikes, kind of round about 2.5% across the project, and that is in the first half. And coming festivities in October, we are clearly seeing potentially, another 2% kind of a price rise that should get in now, depending upon project to project.
So she'll just stay with us. Just want to point out, Piramal Pharma, I think it's up 5%. I think started okay, but now it's surged to the high point of the day. I'm not sure if there is a 5% circuit.
Yeah, there's a circuit. Tomorrow it comes out of T2T.
So that's something we were highlighting earlier in the morning as well with the pharma analyst, but 167 on Piramal. Sushil, so all of this is fine. We spoke with Prestige Estates. I mean, of course, cater to different geographies, right? And then real estate at the end of the day is one geography can be very different from another one. But one of the things they highlighted was that, you got to start a project, you got to put it together, get approvals. So you got to have inventory, right, to be able to launch projects at the same pace. And they kind of hinted that is a bit of a challenge. Demand is not a problem. Affordability is pretty good. Price hikes are being absorbed. Is that something that you would kind of agree with as well in your markets?
Not really, actually, and in fact, to prove a point, actually, in the first half itself, we have launched 8,000 odd crore of GDV in our market, which is primarily MMR and Pune at this point of time. And we currently are having a pipeline of another 10,000 odd crore of launches to be happening in the second half of the year, and that is where the strength of our company, and thereby the ability to deliver the robust pre-sales growth, quarter on quarter, that lies in front of us. And obviously, equally, it is a function of you getting a reasonable amount of your raw material from quarter on quarter, and to that extent, as you know, out of the consolidation that our industry is seeing, the kind of new projects under our capital light business model of joint development arrangement, we added in this financial year up till now in first half 9,000 odd crore of JDV. And since our listing in 18 months, we have added around 24,000 crore. So that shows the strength of brand Lodha, both in terms of getting its raw material and demand in any case for the tier one offline players like Lodha. In any case, I think we all are seeing with our on the ground.
So you said that there is a 10,000 crore pipeline of launches, but in the second half of the year, can you tell us how much of that can you realize? I understand that you added 4 projects in Q2 with 2.2 million square feet of saleable area. How much of all this can you realize in the second half of the year?
See, typically it depends upon the month of the launch, right? Because the launches happens across effectively every month. So generally our target on any new launch is to get to around 30 to 40% of the sales of the launch quantity or launch value in the first 6 to 12 months. So depending upon the timing of the launch, some of the sales will get delivered, but nonetheless, yes, anywhere between 10 to 20% of this 10,000 crore is definitely on the card.
All right, so Sheil, very quickly, you all have done phenomenally well in bringing down the debt, and kudos to you all on that. But you have a big pipeline now, you talk about new projects, etc. What would the peak debt levels be for the coming year? That's FY23 and FY24.
So our peak has already gone by, right? So we are in the journey of reducing our net debt. And to your point, this is kind of a Goldilocks scenario that we are in, where we continue growing our business significantly and in parallel, in tandem, continue deleveraging, which is not quite often that you hear, and that is why the question that you have raised. So our capital light business model of joint development arrangement enabling us to kind of, not put any significant capital in terms of acquiring raw material, yet achieve a significant growth and deliver, pre-sales growth of 20% plus CAGR, on a long-term sustainable basis. What we have guided is what we are currently on in terms of our journey. So we are pretty much on track to deliver 1x of our operating cash flow as a net debt, and thereby meaning our net debt numbers you will keep hearing quarter on quarter keep going down, and perhaps in next 2 to 3 quarters start absolutely tracking our guidance, which is 1x of our operating cash flow equivalent and 0.5x of our equity.
All right, we leave it at that. Thanks a lot for joining in. So that's Macrotech Developers. The stock may be under pressure, but the management commentary is quite positive. They do say that they will exceed their full year revenue guidance of 11,500 crores of revenues for FY23. They say a 13,000 revenue target for the full year is quite possible. But the stock has seen some profit taking lately. Let's do one thing. Let's slip into a quick break. Up next, we'll connect with Arun Selvan D, the president and CFO of Cholamandalam Investment. They had a good quarter. More on that in a bit. Also, we will speak with Anuj Jain, the managing director at Kansai Nerolac